Welcome back. We're here with attorneys Richard Lehman and Stephen Katzman. We're discussing the $50 billion Madoff scandal and the financial fallout. And Richard, I'd like to start off, this segment with you and discussing some of the ramifications of filing taxes. If the deadline for the SIPC paperwork is due on March 4th, and your taxes are most likely, due by April 15th, how do you handle that as a tax attorney?
Very delicately. There's a couple of comments I wanted to make in watching Steve talk about SIPC. I think it's important that everybody realize how individual their situation is. There's going to be people that SIPC makes sense for and people it doesn't make sense for. And then there's going to be the overlay of people that tax benefits make a lot of sense for, tax benefits don't make a lot of sense for. So I think it's very important that everyone get the right advice on this. There are so many variations that are going to make you money by putting it together the right way. And it's not something that you can find out what the other Bernie Madoff victim is doing and count on that as being the right way for you individually.
Because everybody's going to measure their losses differently.
And there's so many permutations to this, where there's a lot of people who won't have any tax loss if it's in an IRA, if they've never gotten any tax basis for it. So, like I say, it's a very individualized study if you're going to make your maximum recovery from this. Now, insofar as the immediate issue, this is not advice that I give lightly, but I'm advising people that get yourself an extension on April 15th. Pay the right taxes, file appropriate extension, but we have no facts that have developed really sufficiently to kind of know exactly where we stand. And if you remember, I'm going to touch upon this in another segment when we talk about tax planning and go in more detail. But if you remember from the last program, people are generally going to want to take their tax loss in 2008. That's when they discovered their theft. And that's when it's going to be the easiest legal standard to claim some recovery from. Now, the SIPC is going to be the first thing that interacts on that, because let's say that your claim ultimately is only going to be for $500,000. That's what you lost for Madoff. That's what you would get your tax deduction for if you get no recovery. When you are filing for SIPC, all right, there's the potential for them to say, you could have gotten $500,000 back. Therefore, you can't take that deduction in 2008 at all. Now, I can't see the sense of people getting committed in black and white to tax positions on April 15th. With the very limited knowledge that we have.
Because if the rules change or something develops that changes how you address your tax returns, you could get hit with penalties and interest.
Well, it's much more, you just don't like to put yourself in a concrete position committed when you don't have knowledge. And as we'll discuss later, I don't want to interrupt the SIPC discussion too much. But there's a lot of facts that need to be put together for one to make a valid claim for a tax deduction in 2008. And you want to make sure that you don't have a lot of things that stand in the way of that.
And Stephen, I guess one of the other things that's complicating this is that in some cases people have pooled their money in one account. So how you would handle it both on the SIPC claim and the taxes are very much affected by that.
Well, that's absolutely true, and we've seen that in a lot of different contexts. Sometimes it's informal, where family and friends have pulled money together, even though only one person acted as the account holder, and that account holder was sending statements showing the pro rata performance to a multitude of people. And that's going to also raise a lot of tension between family and friends as to whether the person who was spearheading those efforts may themselves have some responsibility in all of this. Mm-hmm. We've also seen it where families or friends have used an S corporation to actually hold the account rather than have 10 or 12 or 20 different shareholders each having their own account. So they were able to aggregate enough money to be able to meet the requirements that Madoff had for how much of an investment was required.
But the problem with that is you may not be able to collect $500,000 for each person in the pool. It may be $500,000 for the entire pool.
You're absolutely right. That is a serious problem. It's a risk and a limitation. And when you asked earlier what's going to happen with the court system, it may well get involved on that precise issue.
And another thing is with the pool of pooling of assets, it complicates the tax picture too. If it's an S corp, then the loss would be aggregated over the members of that particular S corp. But if it's in fact a family pool, that may be a bigger problem because if there's no management agreement on what the money was supposed to be and who was allocated what, it seems like it's a real danger area on the taxes.
And even though this is Rick's expertise and not mine, I can agree with you in the sense that the individual investors all felt that they were sharing in the gains and losses, but for a tax reporting purpose, they're not going to have any documentation that may be satisfactory to show that they were truly a Madoff investor. They're going to look like they were an investor with whoever that intermediary was.
Now, if you were a money manager and you placed your clients through Madoff as a service, are you vulnerable to a collection effort by your clients for the losses that Madoff has generated through his scandal? And I guess the follow-up question to that is, if you're going ahead and you're going after the broker, can you go for the broker for the excess amount over the SIPC coverage?
I'm going to answer the last one first because that's simple. The answer is yes, you can. But the nature of the claim against that feeder firm or intermediary brokerage firm typically falls into two categories. If it's truly a licensed brokerage firm, then the question is going to be whether it was a suitable investment and did they do proper due diligence into it in order to protect you from what ended up happening. And that's a difficult claim to show that they should have known. But going back to your first question, let's talk about feeder firms or intermediaries who are not licensed brokerage firms. Those parties not only have the risk of the brokerage firm, but they have the additional risk that they may have actually been involved in the unregistered sale of securities without even knowing it.
That could be a 7-year prison sentence for some people.
It can be a felony, but it also can be what lawyers call strict liability. There may be literally no defense to that type of claim, and one could be forced to disgorge all of the commissions and profits that they made over the many, many years that they were placing people into the Madoff funds.
By deferring the tax loss, by not taking it in 2008, you're only postponing it. You're not losing it. So you really should be making your decisions about recovery first. How much real cash can I get from third parties? That's worth 100 cents on a dollar. Tax deduction is going to be worth 35 cents on a dollar. So first you need to make that analysis. Then you need to see its impact on the tax analysis. Somewhere in between, you're going to have to make some decisions on those things.
And as you point out, everything's an individual case based on the individual standings of the client. Thank you both for joining the show.